As the industry looks toward 2026, First American Chief Economist Mark Fleming offers a clear view of what will shape the housing market next year, gradually improving affordability, slowing price growth, and a slow but steady weakening of the rate lock-in effect. Fleming's outlook emphasizes that the recovery won't be driven by dramatic interest rate cuts, but by steady economic fundamentals and the life events that consistently bring people into the market. Affordability is expected to improve modestly as incomes continue rising and home price growth cools, particularly in markets where values surged the fastest during the pandemic. Some of the overheated Sunbelt and West Coast markets, like parts of Florida, Texas, and California, are already seeing small price corrections. Fleming calls these shifts normal adjustments rather than signs of a downturn, noting that home values remain far above pre-2020 levels. He says the narrowing gap between what buyers earn and what homes cost will play a larger role in easing affordability than rate cuts alone. A major theme in Fleming's outlook is that mortgage rates won't fall far enough to break the lock-in effect that kept millions of homeowners frozen in place. While rate lock-in will still limit inventory in 2026, its influence is slowly fading as more homeowners reach life stages that require a move: marriages, job changes, expanding families, and downsizing. According to Fleming, these life events drive the housing market far more reliably than Fed policy, and they will continue pulling people back into the market even if rates remain in the low 6% range. He also points to negative equity as the key risk to watch. The borrowers most vulnerable are those who bought near the peak with small down payments and didn't benefit from the rapid price gains of 2020 to 2022. While today's equity levels remain strong overall, these pockets of risk could become trouble spots if the economy slows or financial stress rises. When it comes to new forms of home ownership, like shared equity models, co-buying, and fractional ownership, Fleming sees more interest but limited overall impact. These alternatives will help some first-time buyers but won't transform the market. The biggest threat going into 2026 remains a renewed hit to affordability. That could come from another spike in rates or a reacceleration in home prices. But the biggest upside is the possibility of stronger income growth, potentially supported by productivity gains from new AI and workplace technologies. If wages rise faster than expected, the path to better affordability could accelerate, a shift that would bring balance to the housing market faster than rate cuts alone.